Corporate bonds and gilts are often used to gain a greater return over cash-based savings, but without the added risk of investing in stocks. We're personally not huge fans of investing in bonds and gilts because they generally offer a lower return, and because we're relatively young, we seek out those higher returns elsewhere. But investing in bonds and gilts can have a part to play in your investment strategy.
In this video, we're going to discuss what corporate bonds and gilts are, how they differ, what the risks are, and how you can invest. Let's check it out.
Welcome to Money Unshackled, the investment channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe. Also, if you want to support the channel, check out some of the affiliate links that we've linked in the description below. We've listed loads of stuff that will help you become financially free. Let's get into it.
What are gilts? In the UK, government bonds are called gilts. You may have heard of treasury bills or T-bills, which are the US equivalent. By investing in gilts, you are in effect lending money to the UK government, and in return you receive interest known as a coupon.
When the gilt's life comes to an end and it reaches maturity, you should be paid back your original capital in full. Gilts are considered to be one of the safest forms of investing, as the UK government is never expected to default on its debts. Note, I say expected, as no investment is completely risk-free.
Because of this, the interest rate or yield is generally quite small. Neither of us invest in gilts, as personally we seek higher returns elsewhere. But if you are more risk averse or approaching retirement age, then gilts might form a useful part of your portfolio. Remember, it is useful for most investors to de-risk their portfolio as they approach retirement.
What are corporate bonds? Corporate bonds are essentially the same as gilts, but instead of lending your money to the government, you're lending it to corporations. It's important to note that a corporate bond is different to a savings bond, which are generally a fixed-term savings account offered by a bank or building society.
The interest rate offered on corporate bonds will of course vary from bond to bond, depending on what the company is and what its risk profile is. But generally, corporate bonds should offer a higher interest rate than gilts. Big, well-known, established companies are likely therefore to offer a lower coupon compared to less established companies, due to the risk involved.
Credit ratings. You generally get a good gauge of how risky a bond or gilt is from its credit rating. Generally, the lower the credit rating, the higher the interest rate that will be offered, due to the added extra risk.
There are specialist credit rating agencies such as Standard & Poor's, but they are not perfect and cannot guarantee that any investment is truly safe.
What are the risks? It goes without saying that the issuer could default and you would lose your money. In addition to this, bonds and gilts are extremely sensitive to interest rate movements and future movements.
For example, when interest rates fall, coupon prices suddenly will become more attractive to the market and bond prices will rise. Likewise, when interest rates rise, the bond prices will fall. With interest rates expected to rise in the future, this will likely lead to falling bond prices.
They are also vulnerable to periods of inflation. Higher inflation should lead to falling prices and vice versa.
However, none of these price fluctuations actually matter, as if you hold to maturity, you get back the par value, also known as the face value.
Another reason why bonds are considered less risky than shares is due to the creditor hierarchy. Bonds are higher in the hierarchy, meaning that if a company is liquidated, that the remaining money goes to the bondholders before the shareholders. But this doesn't guarantee that there will be any left for the bondholders or the shareholders.
How to invest? You can buy bonds and gilts directly, but it's not the way that we would do it. If you want more information on these methods, then check out the Debt Management Office for gilts and the Order Book for retail bonds. We'll put the links in the description.
Our preferred approach will be to buy bond funds, as you get access to thousands of bonds, all for a very low fee. And of course, we always encourage you to look at Vanguard first.
For instance, one possible fund is the Vanguard Global Corporate Bond Index Fund, which invests in almost 6,000 bonds with a fee of just 0.25%.
Another option is the Vanguard UK Gilts ETF, distributing, which currently has 42 different gilts with a fee of just 0.12%.
Question of the day: do you invest in bonds? If so, why? Let us know in the comments section.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is Money Unshackled. See you next time.